Hi guys, welcome again. Welcome to another lecture. So we've made it to lecture 16. If you haven't seen the previous lectures before, please go back and take a look at them. Start from lesson 1. Don't deprive yourself, as I always say, of a learning opportunity. It'll be a chance for you to learn market profile in depth to where we are right now. I've taken the time to construct this into a series of lectures. We have more lectures to come, but it's very important that you start from the beginning because it will really help you understand market profile, TPO charts in a way that you've never seen them before. What you're looking at is my own TPO chart that I developed some years ago because I really wanted to have something like this on MetaTrader. And I wanted to have it on MetaTrader because it just essentially meant that if I didn't want to spend a lot of money on data feeds, especially as I trade CFDs, but I also trade other things. So I do pay for data feeds. But when I created this at the time, I was thinking a lot more about what if I didn't want to pay for data feeds? It means I wouldn't have had to sign up with brokers where I got to pay monthly. So I developed this. And it works. Lots of people ask me, how can I get hold of this? How can I get hold of this? So essentially, I worked with a developer to make this available to the public if you needed it. Of course, I got to run a server behind it, so it costs. But what I didn't want to do was ask people to pay on a monthly basis for something that I can just give them one time. They pay a small amount of money to have it for the rest of their trading life, right? So it's available for MetaTrader 4, not MetaTrader 5 because of the way it's built. Unfortunately, we can't have something like this on MetaTrader 5, but it's definitely MetaTrader 4. And because we know that MetaTrader 4 is going to exist for a very long time, and it will be updated, brokers use it, people use it, I'm using it right now. It doesn't have to be on a live account, it can be on a demo. So if you don't want to trade with MetaTrader 4, you don't necessarily have to have this on MetaTrader 5. You can have it on MT4 and then look at it or do all your trades on MT5 or on a different platform like I do. So what this is it allows you to have a window into what I like to describe as volume at price. Quite simply, you can see the volume on the chart. It's an amazing opportunity, and it will be astonishing. In fact, it is astonishing to me that a lot of people don't trade like this. They don't use this as a method. You can still do all of the other kinds of analysis that you need to do. So you can still look at your liquidity, you can still look at your volume, you can still look at your time, right? Which is my trifecta: volume, time, liquidity. Right, so that's not an issue, but you get other benefits. You get to see value highs and lows, which are statistical measures, and we've seen through the lectures how super relevant they are. You also get to see things like fair price, right? Fair price is a sign of efficiency, right? Market has to go to fair prices, right? If we can see that, we can visualize that, we can build a very good picture of what to do next. The most important one for me is that you can see a smaller time frame and a larger one. It's like pretty much Russian dolls, right? This is a nesting dolls kind of chart. You don't need to worry about flipping the profile because you can see 2 time frames in one window, right? So you don't need to worry about consistently changing, flicking back and forth. You look at some of the YouTube streamers that are trying to do top-down analysis from time frames. You see them go from daily to 4 hourly to hourly. When you're trying to execute on a trade, you don't have that much time to sort of be doing that, especially a lot of these guys are intraday trading. So for me, it feels like a lot of effort is going into something that can be made incredibly simple. Like you can see a lot in one window. So for me, this is a real market at a glance. So if you want to be able to focus a lot more on your execution, which in my opinion is partly the reason you will be as successful as a trader, is that you can consistently execute, you can get those reps in. If you want to focus on that, then this is the way to go. And that will allow you to get better at trading. It will allow you to be able to execute in relevant areas with a good understanding of the market mechanics itself. It's done wonders for me, so I'm pretty sure it would do wonders for you. If you want access to it, the link is in the description below. You can see the Discord server link, so you need to go to my Discord and you'll have access to it there. You can see the link, bottom left hand side, it's always flashing up, so join the Discord server. I do some amazing posts on there, cover things like fundamentals, so I go through data stuff, I pick out all the good things you should be looking at, trades you could be making, trade ideas. It's not a trading signals Discord, right? If that's what you're looking for, that's not what's there. What I have available is the ability to give you a professional view of the market. People come to me for mentorship sometimes. I'm open. If you're at that stage where you feel you're looking to go pro and this is something you're going to do professionally long term, I'm open. However, the Discord is amazing, full of a ton of free stuff, so check it out. Link in the description below. Anything else, any questions around these lectures, please put them in the comments. I will happily address them on the comments. No spam comments. All spam comments don't even show. I don't bother about that at all. If you have questions around the lecture, amazing. I'm happy to help you. I've been doing this for a very long time, as you'll find out as you go through the lectures. I've spoken about this before, so I'm not going to rehash it, but I've been in this business close to 17 years. I'm an old hand, right? I do this for a living. Like I've always said in the lectures, that don't do anything else. I trade for a living. So there are a lot of influencers out there. My channel's really small. It's small for a reason, because YouTube doesn't promote people like me. They promote people who have got that wow factor, right? I don't have that wow factor. What I have is the ability to help you to become a better trader. The wow factor guys, they're killing it with the wow factor. Good on them. They get promoted heavily by YouTube. Small channel. I know if you found me, it's because you've been doing some deep dive and deep digging. Well, you found where you need to be. For those people who probably just literally saw this video on their feed, YouTube tried it out to you, well, you may like it, you may not like what I'm offering here, you may not even think trading is a serious thing for you, whatever, you can stick around. Ultimately, this channel will never become one of those kind of channels that are so popular out there. It's not going to be, because it's just not who I am. It's not going to be one of those kind of channels where it's all lights and flashing. That's not me, never be me. So fortunately, that's what you're here for. Someone to keep showing you how you can make 6 figures a month. This is not me. This is not that channel, because I've been in the business a long time. I know what some of these guys are doing. I know who they're in league with, and I essentially know that they're misleading. 90% of them are misleading you. Not everyone, 90% of them are misleading you. And if you keep having those kind of expectations, the chances you do well in this business is virtually zero. If you have realistic expectations, when I say realistic, I'm not talking about what some people say, expect to make 1% a month. This is not the nonsense that I'm talking about. You can make more than 1% a month. I encourage people to dream as big as you can, but don't be stupid. You can't take a $1,000 account and turn it into $100,000. People have done it. I'm not saying it's not. Everything's possible. For God's sake, Einstein says space and time can be bent, right? This is a reality that couldn't have been conceived of in the 15th century, right? But here we are, right? We now understand that space and time are essentially one thing. Time decay or whatever is a physical process, and we know that as humans, because we have chemical processes going on in our body, yes, we're going to age, and for us it's going to feel like it's time passing, but obviously we're talking here about the effects of gravity on our body. Bit of science there. But the truth of the matter is that we couldn't have conceived of this idea a few years ago. Time was a very realistic, non-subjective thing. Today, time is subjective. So the point I'm trying to make is that it really doesn't matter ultimately if someone says you can't do something. There are a lot of things we thought we couldn't do that we can do today. So I'm pretty sure it's possible. With AI and everything developing, someone is going to be able to take one day $1,000 and turn it into $100,000. But that's when we're going to say the game has really changed, right? A lot of people won't have a place in trading and investing if that day ever came where you could take £1,000 account with a degree of certainty and turn it into 100,000. We're talking outlier stuff, but realistically, you can take a £1,000 account and turn it into a £10,000 account. Definitely. You can take a £1,000 account, even turn it into a £15,000 account. Definitely. People have done that and they keep doing it repeatedly. Not a thing. You could probably take, because there's leverage, right? You can do this because there's leverage. If there wasn't any leverage, then I would argue that it would be very difficult to do without leverage applied, right? It's the same in all industries where there's leverage, whether it's real estate. You know, you can essentially buy a house for, 20 grand. Well, depending on where you live in the United States, you could maybe do it up, get it to, 50, 60 grand. And then, you could probably sell it for $500,000, right? Depending, right? So people can do crazy things when it comes to assets, right? Trading has far more leveraging than those industries. So it's a double-edged sword. Either way, if you have a lot of leverage, you can misuse it, you can mess it up if you don't know what you're doing. If you have a lot of leverage, you can you really use it to your advantage and make a shit ton of money, right? And when I say shit ton of money, of course, I'm not saying shit ton of money, it's relative, right? So if you've got 1,000, you can make 15, that's still a shit ton of money, considering you started with 1,000. Again, if you've got 100 grand and you want to turn that into $1 million, perfectly plausible. In fact, it'd be far easier for you to do that than say someone even turning a grand into 100 grand, right? So the bottom line is that people start in any kind of investing environment or trading environment. The idea is to grow. It's not to just consistently lose money, right? So the point I'm trying to make to everyone is that it's possible to do, but don't be stupid, which is kind of what you find on social media, is people being silly about what they can achieve and what they can't achieve. Awesome stuff. Always get the pep talk from me every lecture, because that's how I like it. I like you to understand what I'm bringing to the table before you even sit and listen to me, because there's a lot of BS and I'm just trying to make it perfectly clear where I stand so there's no issues. I think everyone should be using a TPO. I'm able to give you access to it. It's not for free, but it's not going to kill you, break your bank or anything like that. I need you to support me on that project because I've got a server around. So I'm open about that. It's not a problem. So if someone thinks it's a bad idea for me to sell them something, then it's your problem, but I'm not going to give you for free. You can go pay someone else for it because legitimately you might feel that they're worth having it. Not a problem. But if you want this from me, you want easy access, you want the comfortability, the freedom to do what you're doing without being indebted to some firm in the United States, then fair enough. I'm here to support that. I will teach you everything I can on market profile. I've got a lot of free content here, so a lot of this stuff is not monetized. It's just information for you that I think will be helpful for you. Simple. There is nothing else to it. So I am clear cut all the way. Anyway, a lot of you, if you're watching lecture 15, you probably already know this, or you're watching lecture 16, you probably already know this by now. So I'm not going to drool on about it. Thank you very much for spending the past couple of minutes just hearing me out, and let's move on to what I wanted to talk about today. So a lot I want to discuss today is pretty straightforward, right? So we're going to maybe turn it down a notch and take us back to some basics so we can really start to understand how we break down this profile. We've done a lot of risk management stuff. We've gone across profiles, covered dailies, shorter term profiles. We're still going to do a lot around this. The profile is the ideas you can construct around it. It's immense. So many nuances we're going to discuss in coming lectures. But for now, let's talk about one of the other nuances that are going to help you as you develop your understanding of the profile. So we're looking at a daily profiler cable. Now we discussed this before. Last lecture, last couple of lectures, we've been talking about the draw, right? The draw and stops. So that's our liquidity part of the model. So we've seen on a daily, we've seen daily profiles. This is essentially 1 day. So we've seen the price going down 1 day, 2 days, 3 days, 4 days, 5 days, and then we're pulling back up, and then we're hitting those highs and drawing on stops. We saw that, we went up there, we held, we drew on stops, popped down, went back up, draw on some more stops, pop down. That's an evidence that we're distributing and we're going to go lower, right? And we did say that we expect this market to drop and then draw on the stops that we see under the volume here, second part of our trifecta volume, so we can see the market draw under that level, and now we're sort of recovering. We've got a gap in value, so I'm expecting this to get filled. So this is a perfect opportunity to visualize that we're going to rally out of here at some point, and we're likely going to trade for the fair price. What do we have at the fair price? Pretty straightforward. We have a stack, right? So we discussed stacks, offer stacks and mid stacks, right? So offer stacks where there was abundance of sellers, we get limit orders tend to be there because that's a relevant price level, because we've seen volume develop there. Wherever volume develops on a profile, people are likely to stack orders there, so it's going to act as support and resistance. Really simple. The orders that people tend to see on the limit order book are consistently changing because of algorithms. What we can clearly visualize with a profile or TPO chart is we can see where that volume was historically, which means that it's going to be resistance. If I was going to stick a limit order at the central order book, that is where I'm going to put it. Most people do that anyway, right? Because there was real volume there, it means real traders supported it. Most likely very large traders or very large trades were generated at that level. Whether they were algorithmic, whether they were done by a human, does not matter to us. The fact of the matter is we're going to see a lot of that. That was echoed by a huge drop where we've got this recovery, so we're expecting a rally at least into the stack. That's pretty easy to understand, right? We've got a couple of other nuances to take into consideration. Where the value area is, it's what we call falling value. So if value is falling, it essentially means that price is likely to go lower, and any price pullbacks are likely going to be met with significant resistance because value perception, which is the value areas, are consistently driving lower. So if you were to take away all the TPOs and just leave the value, that's what it would look like. That's pretty cool as far as I'm concerned. The fact that you can see this and I can tell you all of this in the space of a few minutes, pretty cool. When you think about the amount of time traders spend trying to do analysis before they take a trade, and on social media, everyone will tell you 90% of trading is sitting on your hands and watching and looking and deciding. It's true. Most of the time, we're not always taking trades, but you need a fixed point where you always go in and take a trade. So the idea that you just sit down all day, every day, just looking and waiting for that one day in 10 days where a trade's going to show up, you're never making any money if you do that. Unless you've got a huge account, which is what a lot of some of these people who say this are normally older traders who've been trading for 30, 40 years in some cases, have huge accounts that they don't even care anymore about trading. It's like, whatever, like I'm so retired. And those guys, of course, if they take a trade every 2 weeks and they hold a trade for 6 months, it's no big deal. They make a pension. Everyone's happy. But if you're a new trader and you're trying to build capital, you're trying to grow, I don't expect you to be doing that. That would just be nonsensical. So whilst it's a nice, interesting idea, it's not realistic with trading in itself. Most of the younger, successful traders, not even that old. So when I say younger, I'm even thinking about my age group, not even the 20-year-olds, but my age group. No one's going to do that because you're still at the phase where you're trying to still get bigger if you can. So the bottom line is that no one trades like that, not in reality. So you need to have that fixed point where you get in, where you always know you get in, and it needs to be frequent enough so that you can see how you can generate your profitability. Anyway, so we can also see, back to those nuances, we essentially can see what we call minus development, right? So that's the single prints within the actual distribution. This is what we call minus development. It's essentially what you would easily describe as selling that was not opposed at any point. So buyers did not attack those sellers and trade those prices again. Or if it was buyers, the market was going up, where essentially sellers did not attack those buyers, right? So it's unopposed buying and selling areas, right? We call them minus development because they're going to bring in a level of resistance and support depending on the direction. So it's exactly the same notion. You're going to see a lot of resistance and support around minus development. So that's another good nuance to take into consideration. Right. Again, we look at things like gaps in value. This is also another nuance. Like gaps develop often when we do profiles, and those gaps become areas where price has to fill. Depending on the length of the profile, like daily profiles, gaps will fill really quickly. Weekly profiles, it can take a little bit longer. And in some cases, you'll see gaps on dailies and weeklies, and all need to be filled. So it's not a one size fits all. I see a gap, it fills tomorrow. Most of the time, you could see a gap and it doesn't fill tomorrow, it fills a couple of days down the line. But what we have to bear in mind, if we see a gap, there is risk, increasingly more risk, maybe even more volatility in the direction of the gap. So understanding that nuance means if you're shorting and you're shorting against a gap, like, so let's say for example, what happened yesterday, we closed lower. I was expecting that gap to be filled, and I spoke about it, I think it was in lecture 15, right, about the gap filling, right? I posted this on my Discord, link in the description below, you can check it out yourself. I posted it and I said, we are going to fill the gap. We started to fill the gap, it looks pretty good, and then we didn't fill the gap anymore, and then we sort of fell off a cliff. Now, everyone thinks the market's going lower, absolutely, that's the natural thought process. But we're too deep in the hole. I like to say we're too short in the hole. So we need to say ultimately a pullback before we can re-enter into a short. Now we have other anomalies, like we're seeing a lot more stacking at the lows, which tells me late shorts. So when I say late shorts, I mean people who are shorting but late in the game. And in my opinion, 90% of the time they do get wiped out. Of course, this market is falling, so there's the perception that it's just going to go lower, and that's where the danger lies. So for most traders, if you see that, it's a good time to either step away from the market and say, no, I'm not going to follow those guys, or position yourself, wait, in other words, for the market to rally, and then find a way to get in. Now we can see what clearly happened is we traded low of day, right, and drew on stops on the day's low instead. And so instead of go lower, we trade low of day, took the stops, right, below here, and then rally. So anyone, and if we split the profile, will see that draw. So we went down in Asia, drew the stops in London. So that would have been a really interesting time play. So 7 a.m. pre-London open, which would have been 8 a.m. London, right? You see the draw at 7. So this is a good opportunity to get long with stops below the low of the London to push this potentially for a value trade or even through the gap, depending on the kind of day. Because value perception is depressed on this day, the most I would say you could get is a value trade, right? So we've gone to fair price where it looks like we're going to be able to do P, Q and R period a little bit higher, because that would essentially be the NASDAQ open, which will be what you'd look at if you're starting or you're looking at a trade opportunity into the US session, right? You won't want to trade before that. So you remember my time trifecta is that you have to trade at major times. You can't be just trading in between. Not a good idea. So if you're considering the time trifecta, this is a really good position in the market for a long. Again, quite simply, why? We've seen a draw. So that's liquidity corrected. We know there's volume behind this because I think London volume is currently the highest volume so far. I'm not really sure. We'll have to check that, but I think so. And if it is the highest volume of the session, then it essentially means that the market is still demand side. We've had that, I think the Bank of England's interest rate decision was also today in those hours. So if you look at this here, I think it was 12 noon. As a result, we had this movement in O period, which was pretty strong pre-market. So my expectations, and I say 12 noon London, my expectations were going to go higher, right? We could retest some lows before going higher, but we might end up going higher. So I would stick with that narrative. But again, we're not going to trade off that yet. We have to see the NASDAQ session open and complete that 2 to 3 p.m. window. That needs to happen. 2 to 3 p.m. London, we need to see that if we're going to anticipate any kind of rally. Right, so you can see easily how people can get trapped in positions they don't want to be in if they didn't have the right kind of tools to see what's going on. I could never be in that position. I could never be short. Like, I could never be short into today. I couldn't, like, there's just no way, because I can see there's a gap and I'm better off waiting for the trade to the gap. And I can also observe that, to be honest, I'm short in a hole. You can see that. To be fair, you'd see that on a candlestick chart too. But that's if you have the good sense to look at a daily candlestick chart and understand how you want to trade against that. If you don't, most of the time you're not going to see this. Secondly, I can also see that we're drawing on liquidity underneath the volume. So that's a good place to find a lot of liquidity. There's just too much here that's telling me that we're going to get a rally back to the upside, that we're not going to see continuation just yet. Also, there's the efficiency issue. Why would I want to short here if there's an opportunity to short here and short here? So traders will consider that, right? They want the best possible prices, so they will wait for the market to pull back. So there's a lot of disadvantage to being short. And I guarantee you, if you're looking at this lecture, you're probably seeing it in the future. But if this was a live lecture and I told you, if you don't believe me, just put in a short now. So if you think the market's going to go lower, I'm talking out of my a-hole, then sell the market. See where that leaves you. Sell the markets, put your stop where you normally like to put your stop, because that's also some of the things that kills traders, is where they decide to place a stop. So you place your stop, disregard everything I've told you in the previous lectures about how to risk manage, right? You place your stop where you want to place it, and then take the trade, and then give me the results in about a day or two. Guarantee you would have lost money. Right, and that's because you don't have these tools. Unfortunately, you don't have this insight, so you don't know. If you're watching this, you don't have the TPO track, then you just don't know. So you need to go get it. Wherever you get it from, you need to go get it. That's the only advice I can give you, right? If you don't have it, then all of this is useless to you, right? To me, it makes a lot of sense, but to you, it's useless. And you can't replicate this. You can't You can't replicate these visuals on a candlestick. You just can't. Trust me, I've tried. You can build a sense of it. You could try and visualize it, but it's too much work and you're not going to execute properly, because it's not at a glance. Your brain likes to do the easiest thing. And if you don't believe me, read a book called Thinking Fast, Thinking Slow, which pretty much describes your brain in the context of a system 1 and 2. Your system 1 brain, and I've done a YouTube video on this before, but anyway, your system 1 brain essentially will always take over your system 2, because your system 2 needs a lot more cognitive capacity. It needs to stop and think, basically, which is not what humans are good at, and they don't like to do it. They don't like to stop and think, because it's just too much work on the brain. The brain has logged a series of behaviors over your lifespan, and it's cataloged them in system 1. So it would just literally go and draw a reference all the time from system 1. That's the first place it goes. So our system 2 brain is that brain that allows us to think. So what do you think is going to take over 90% of the time in trading? It's system 1. So you're going to lose money most of the time because of this. If you want to control it, you need something that has already done the heavy lifting for you. So the thing that system 2 would do, it's already done it. And that's what TPO chart does. It does all the heavy lifting. So your system 1 now can log all this information and just take action. You make everything easier on yourself. Trading doesn't work for a lot of people because they have to analyze. Not everyone's got an analytical brain. I think it's like I'm an INTJ, right? In terms of Myers-Briggs, if you believe in that. I do wholeheartedly. I've seen it in action in both the corporate world, trading. I've mentored so many people as well over those years. Myers-Briggs is spot on. Don't believe in Myers-Briggs, then well, it's up to you. But Myers-Briggs for me, the nuts. I've heard all the arguments around it, still the nuts. If you do a 16 personalities test, whatever, you will know what you are. And my personality type, I think, is 1% of the global population. So I'm a rare personality type, right? And I won't even want to start to describe the people that have my personality type, fictional and in real life, right? They're the wildest people, right? They're the tacticians of this world, right? But that's me. That's my personality type, and I see it resonates in me. I'm very strategically conscious, and that's not just in trading. My everyday life, I'm very strategic. I often think about things in a way, and people who have mentored will tell you, I think about things in a way most people don't think about things, and you see that across my channel anyway. So it's not me just saying that. So I'm well aware of who I am. But then there are people that easily are not that. They are other personality types. That analysis is going to kill them, literally. So everyone needs something simple so they can become the trader they want to be. Okay, moving on. So that's some of the nuances we've discussed, right? So these are, I think if we understand those nuances, we've covered a lot already in terms of our understanding with the profile. And we can also be a little bit more dynamic. We don't necessarily have to be all about, having to do everything the way I've said, right? We can be our own flexible individual. What do I mean by that? So for example, I told you, well, we've seen a draw on stops, we're going to go short, and I've been saying that for a while. You didn't need to think about it that way. You could still be short without thinking that I care about the draw on stops. For you, being short could be, I'll get short if I break the lower day, right? And that's where my short is going to be. And my stops are going to be above the initial balance, right? That could be the way you want to trade it. It won't really conform with everything I'm teaching you, but the fact that you've got this additional information here, you can see where volume is, you can see how profiles are made. You can develop whole new ideas around how you want to participate. We've talked about some of the more traditional ways of trading a profile, which is, for example, doing value trades. So whenever we set up value and we open and returns, kind of a mean reversion trade, we can trade through it. We've talked about the limitations of that. So trade through it. What I mean, day period, we went through value. It's a high probability setup, 70%. But it happens at unexpected times. So in order to trade that, I think you need to be in front of the screen a lot. And that's why it's people in the old prop firms used to do value trades a lot, because they were easy to teach. Traders can come in and do them, and they have a fixed entry point all the time, but they sat in front of their computers almost all day. It was literally a full-time job. As a result, in fact, when I say full-time job, we're talking some people will crunch all the hours they can in front of it. It probably even won't want to go home. The bottom line is that, of course, if you have that much time in front of a screen, then yeah, you can do value trades easy. Could you do them if you only wanted to trade a specific session, or you don't want to spend too long on the screen? Then no, you can't do it. It's not going to work out for you. But they're really great opportunities to trade and get a high accuracy rate. So that might be a way you want to go, depending on how much time you have, right? If you don't know about value trades, please go back and watch the previous lectures. I'm not going to go over that now. The other thing I want to discuss today was profiles and states. Right, now profiles go through states, and they're very limited the amount of states they can achieve. Right? Naturally, every distribution, if we know mathematics a little bit and we've done the bell curve theory, we understand that with a bell curve, it's a normal distribution. That's what you see. It looks like a bell, and that's something like this profile here. Right, so zoom in a little. Right. This is a bell. Right? It looks like a bell curve, normal distribution, thin on the wings, fat in the middle. We describe that as volume, quite simply. Right? And the reason we do that is because this state indicates that 80% of the money was short term, 20% was long term. The 20% long term was clearly buying up all the short term, right? So there was less long term money. In other words, the market was handed over to day traders, and the brokers are likely juggling the inventory. Why are they juggling the inventory? Well, they want to give it to the large entities. That's simple. That's a simple enough idea to catch. So this kind of balance implies that we're going to move into another phase, which is likely going to be a test or an imbalance. In this case, we had an imbalance, but closer to a test because of the responsive seller here in J period. Right, so the market has tested the upside, imbalance from the balance, and now it's going to decide what to do since this was a test. So its next logical state is going to be either to drop back into balance or to imbalance further. In this case, we saw it drop back into balance. Now, if we think about states normally, right, I'm using a daily profile to illustrate this. It's even more significant on a weekly profile, and we'll take a look at that. But when we're thinking about states, we're thinking, why did the market move from a position of no long-term money to increasing the amount of long-term money in the market, which tested the upside heavily and brought in more long-term money in the form of a responsive seller? We got to think about that. Most likely, the market imbalanced because they were waiting for something, but they needed to have a position. It could be a long-term position, so it took them time to build it. Now they've tested the upside, which will be, in other words, they've run some stops, right? And that's what results in the test. So the stops get run, we close lower, but we don't necessarily come back and hold within this trading range window. So this top to bottom window, we don't necessarily start coming back down there. We also know that there's a low likelihood that we're going to be able to do that because of the support level that's now sitting on here. The second thing is we've come back now and balanced, which means that we've tested and then we've gone for another accumulation run, which is really weird. So now we're thinking we've come from short term, brought in some long-term money. So at this point we like to say, because we're looking at an imbalance, it's now gone from virtually no any long-term money to, let's say, 60-40. So it's 60% long-term, 40% short-term money, which means the long-term money is now in play and they're defending this level and they've gone back into a balanced state. So now they've gone back to waiting for something. So they've start accumulated position, probe the upside and held. So the next logical thing we start to think coming into the next day, so we've seen balanced test, we need to see something more significant imbalance, right? Which means we get a trend day, or what we call a trend day profile. So that's what comes in this period. Now, if I disappeared, I can't, but I wish I could. If I disappeared all these profiles and I asked you, so after an imbalance, what do we expect to see next as a phase? Well, the next will obviously be a test or balance. We could have another imbalance, but that's very rare on a longer time frame. What we tend to have is we're going to drop into another place where we're either going to balance or we're going to test. Now, depending on what we get, could tell us whether what's going to happen next, right? Whether we're going to continue going or we're going to drop off. Remember, we've seen free balance so far, which is accumulations of some kind, and it's been confirmed by an imbalance. So the next thing we're likely to see, if you asked me personally, I'll say, well, we're likely to see balance because this market is a little bit exhausted and we need to balance in order to pull lower so we can draw in more bids. And we know that the perfect level to do that is where there's volume, right here or right here. So we're expecting a revisit of this anyway. So let's see what happened here. So instead of having a balance, right, full on balance, we kind of had what we call a normal variation, right? So we're kind of balancing, but we're also extending the range a little bit, right? And that's what we get here. We get an early extension of range in Asia and then we balance around that. So let's say now the long-term money has dropped from a trend day, which would be 80% long-term money. That's why we got the extension, 20% short-term. And now we're seeing long-term money leave because we're probably down now to 50-50. So 30% of the long-term money have decided that I'm going to exit the game today, and that's that. So we don't get any more movement. That's the first sign that we've completed an entire cycle phase. So we've gone from balance to test to balance to imbalance, and then we're going back to balance, right? So we go, and when we go back to balance, what do we see? We see now that the next day we go into what I'd like to say is a normal variation, right? So again, we've gone from that to 60% long-term money, 40% short-term. So long-term money's come back in again, but it's to close the market lower. So what do you think is happening at this point? Naturally, if we're saying that, we're assuming that the market is making a play for the bid stack. Pretty simple. So that's the importance of understanding phases. So we got balance, test, and imbalance, 3 phases. A test could be a normal variation. A balance can be some combination of a normal variation and a normal or neutral profile. An imbalance is a trend line. Not complicated. So if we know that normal variation profiles are kind of short, so they're not complete trend days like this, their value areas are not as extended. That's the characteristics. They're kind of got shorter value areas, but they look a little bit distended. Right? And then balance areas have tighter value areas because it means most of the volume was very tight. It traded around a specific range. So we didn't see an overextension of value, right? And then trend days, of course, have extended values, and that's the only states we have. So if you look at these profiles, we only have either what looks like a normal variation where there's some a large amount of long-term money, not at the max, and they're competing heavily with short-term money. And this is very common when the market is consolidating lower, right? As soon as we start to see those value areas extend a little bit, which is, for me, this is kind of like a triple distribution. This is similar. We get a combination of a test and then an imbalance, right? And that happens at the bid stack. So again, really good clues that we've seen a test imbalance combination, which would imply we're looking at now somewhere between 60% long-term money, maybe even 70% long-term money that are coming in the market now. And then we see a balance, short-term money, 80-20, and then we get an imbalance, 80-20, long-term to short-term money. And then we go back to balance, and then we finally get a test, and then we get another test, which is somewhat a test to balance, right? Short value areas. And then we start to get back into long-term money again, closing the market lower. Again, what does that tell you? We're probably trying to come back to the bid stack again to find more buyers, right? We get close enough and then we rally back up again. But if you look very closely, we attacked the bid stack here instead of go all the way back down to this level. So the market takes these predictable fashion for states. And if we understand that, we can really start to build a good picture of holistically what state the market is in. Are there more long-term buyers in this market or short-term buyers? And how is the ball changing hands? It's an extra layer of understanding which might help you think about things, especially when we're looking at these frames. So if we take that now to today, in terms of relevance, this is a market that has set itself up, in my opinion, to balance. We're already seeing that short value and that tightness. Now we could transition to a test. So what have we seen? We've seen imbalance, we've seen balance, we've seen further balance. So the next thing we're expecting is a test. So what would a test look like? And we're going to get a chance to analyze this. So we could get a test could be, we pull up, we hit the gap and we pull back out. A test could be, we probe the highs of this, pull back a little bit, and then go for an imbalance and hit. So that's a possibility, right? But we need to see the long-term money start stepping up. Now, if the long-term money decides to step up in the form of an imbalance straight away, then that's a really aggressive move, and that would probably start to make me think that we're going to probably take out the stops above the highs here. What if I see a test, which is kind of a normal variation, slightly extended value area, maybe a pullback, I would assume that we're going to go back into a state of balance, and then maybe we test again and then drop out into an imbalance to the downside. So I can use my understanding of state to kind of give myself a bit more of a predictive edge in terms of what I need to say for me to take action in a specific direction. I'm still going to trade the way I normally trade, but for a trader who might be thinking, I want to attack this profile differently. I like everything that you've said, but I want to attack it a little bit differently. How do I go about doing that? Well, this is one way to do it, is to look at it in phases and put a lot of your attention onto the weekly frames. Let's take a step back. Let's look at what's happening on a weekly profile. So the exact same concepts will apply. We're just looking at profiles now that are a little bit more extended. So there's a bit more volatility standing across the week. So these profile shapes, though, they're exactly the same. We're still seeing that transition from the amount of, let's say, short-term money that is also kind of big to the amount of long-term money that's investing over time. Right? And you can see that too. So here we got a test, we got an imbalance, and then we got what looks like a normal variation, so balance to test. So we can see that reduction from long-term money, and that's telling me that we're going to likely try and probe the bid stack. We already did that in this one fell swoop. We balance, and then we immediately imbalance. This is a strong move. So it's telling me that we might set up again for balance, maybe even test, but the next thing should be an imbalance to take out, to retest this bid stack level. So we're shaping up in a way for the market to do another run to the downside, because what have we seen? We've seen a draw on stops, a pull back in, and a hold within this bracket. So my expectation is we're going to start to distribute into the bid stack or potentially take out the low. right? So the bid stack can't hold this. We're going to probably trade the lower day period, and we're going to draw on stops and then rally from there. I'm long-term bullish on the pound anyway to about the 140s. So even if we drop to the 131s, I think it just gives us more time to get back up to these highs. Again, I could be wrong on my long-term direction, but I'm not just trading my long-term direction. I'm also trading day to day with an understanding that the longer term money is going to go in X or Y direction. This is important. It helps you when you're thinking about where things are going and positioning. This is a weekly profile with 4-hour rotations. So if you wanted to trade a 4-hour frame, you could. And you can use this as a reference, right? Nothing wrong with that. There were lots of opportunities to do that, and there were some really big moves if we were looking at this from a reference point. So let's move this up a little, right? So we've seen that major draw on stops initially, and we've seen further draws on stops, right? All of these were trading opportunities. So for example, let's take the one in W period. And I know we've discussed this in a few other lectures. If I split it up, there was a trading opportunity. 4-hour frame, we got up in W period, we broke lower. What was stopping you, seeing the close in W, is getting short, putting your stops up here, 35 pips, that thing moves 75 pips. That's easily a 2-to-1, and we haven't even probed the other areas. Let's split this. What happened next? We rallied a little bit, and then we finally hit the internal liquidity, so the liquidity within the value or within the profile, right? We can see that J period low. We drew on that and then rallied back up again, right? So if you wanted, you could have traded a stop around here, right? We hit that, got long in J, put a long here, 43 pips stop to the low, and then say, well, I'm going to rally back and to the highs, maybe D period highs, maybe W period highs, right? Again, we went up there, cut back in Y period, right? Because there wasn't really much of a play. You could have been short in W, had your stops above, got hunted, but Y period closed lower. You can wait for a rally back in a Y, again, 46 stop, and then try and push this down and say, well, I think that's it. We should be hitting the low of I period. That's what 134 one versus a 45 pip, 43 pip stop, depending. So you could have played the short term as well at every point, right? Obviously now we're down here and we're putting in some, we took out the lows here, we're into the bid stack. So again, there's nothing stopping you playing the long side on a 4-hour and the rally on you, wait for a pullback lower, get short, get long, 37 pip, and see if you can rally this, maybe above a Q period high or into on a post 7 selling level, minus D. Right, minus development is hard to get through, so we might fail somewhere about 95, 96 pips, right? But at least try and see if we can get to the highs, and if you're a bit nervous, break even the trade. Roll the stop to break even, cover cost, and then see if this thing continues. If it comes against you, so what? We take out the U period low, that gives you more information that, okay, if we've done that, then we're likely to go for the bid stack. So I'm gonna look for short positions going forward. I should get some really nice runs, providing I'm trading my time trifecta. Fantastic, really easy done. So this is the way we want to look at it when we think about states through different time frames. So here we've looked at a weekly, 4-hour rotations. We've looked at a daily, 1-hour rotations. And finally, we've got a short-term window for people who want to intraday. What does that look like? Same concepts, right? We generally have imbalance, tests, balances, test, imbalance, strong imbalance that was, test, and then now we're going for what looks like another imbalance, right? So we can see where the opportunities are. Now with the intraday, your time's more important. So here you can say stops at the lows, we got a relevant high, there'll be stops above. What do? We see 7 a.m. London, pre-London Open. We have a massive draw and a close higher. So this is open, go, draw, close, stack. That's immediately telling you that a lot of buyers sitting in here. This is a long trade on an intraday. Market pulls back into value. You could take it straight on the gap fill. That's 15 pips, thereabouts. This thing did 43 pips. It'd be to the high, it was 45 pips across the Bank of England report. So seeing that draw on stops, that hold, that pullback in, reference the bid stack, deciding where to get in gets pretty straightforward. You would know that the move on London wasn't really legitimate. We had a slight drawn stops on the high, come back in, and then we were off, right? Immediately blowing out this level. So even if you're light, we blew out the 8 a.m. high and closed higher. You could come in and execute a value low of this bar here, and you would have still been in a fairly decent position. That's 15 pips. This market rallied about 36 pips. So yeah, of course, you cut your profits a little bit short, but you still got a 2-to-1. Obviously, I say this repeatedly, trade location is really important. So, these markets are so precise that if you get in too late, you're often at a disadvantage immediately. So intraday trading requires a lot of precision. That's why not everyone can do it. That's why I advocate finding a fixed point that you trade all the time. And that's why my time trifecta is important, because the risk of you taking long trades here and getting washed out is really high, especially if you have this analysis paralysis where you're just stuck, you can't know, because you don't have a good frame of reference. If you have a TPO chart, you don't have that. I don't have analysis paralysis. I know immediately what I want to do, right, from the moment I see it. Right, the way this market's setting up is telling me that all I need to do is see a strong Nasdaq and I'll short this to get the bottom of the market again, right? I can see a lot of reference points. I can see there was an offer stack up here, right? This would have been really difficult to get over, right? I can see there was a lot of volume trading on the way down. I can also see there was a drawn liquidity to the upside and there was a liquidity high here, so there's going to likely be a drawn stops here, so we're going to move lower. Depending on volume in the Nasdaq relative to everything else, it will give me a good clue as to whether we're going to go lower, initially draw in more people and then go higher. Right now, I need to see the completion of the Nasdaq open, which is effectively going to be the next minute, and then by 11, I'll be able to make that decision. Bottom line is that you can make these decisions really quickly based on what we're seeing. So if you have the right tools, you're going to find it quite easy to position yourself as long as you're following these really basic rules: liquidity, time, and volume. You can see these all three in action, then just go in the direction of where they're telling you to go. What you don't want to be doing is taking trades at 11 o'clock. That would have been a bad idea, even though there was an opportunity, but your idea is to reference the 7 a.m. window. So even if you set a limit order and said, I'm going to put a limit order here to trade, that's fine, because you're still referencing the 7 a.m. window. Of course, you might not have felt like you wanted to put a trade up here and cover 24 pips worth of risk. Of course, absolutely. But you don't want to trade too far out of this 7 a.m. window. If you start to take trades now at 12 to go long, and now this is just, it's because you couldn't get up early. You couldn't be professional. You couldn't do what you needed to do. And that's why you're stuck taking trades here. If you were up early, from like 5 o'clock in the morning in London, and then you were on your desk by 6 o'clock, 6:30, and you're looking at the market and thinking, I just need to see pre-London and London, and then I'll make a decision. And then you see a draw in pre-London, you're already anticipating we're probably going to get long. Let me just see where we open the 8 a.m. window, and I'll let's see if I can get trading at 8 a.m. Right? Are we going to hit any major levels? Obviously, we stopped here, boom, close. So you're thinking, okay, we're probably going to go a little bit lower. I'm going to target here, but then we open and we don't quite do that. We break to the upside. We clear the 8 a.m. low. So at that point, if you missed it, right? If you didn't think that, okay, just getting to value high would be good enough in a long trade, and I'll have my stops under value low, it's a 12 pip run, I'm happy with that. If you didn't think of it that way, then you wouldn't have got this last tick. What you would have done is see the market hit and start to move, and then maybe execute along the way and said, look, I'm going to just stick with the 17 ticks, right? Whatever. Or you might have even cut yourself short and say, I'll sit under the fair price, whatever. Right? Whatever you decide. I like value low, but 16 pips, you still got a decent run. I mean, this market did 50 pips in the end. So either way, there was money to be made that day, no matter how bad your execution was. But what you don't want to be doing is trading much later now, after you've seen the move and said, I really needed a confirmation here, and then I was going to get a trade here, and no, that wouldn't have worked, because as we got into the US session, the goalposts could move significantly. These are two different sessions with people with two different idea sets. not a good idea. And this is relatively the same with most assets. So again, like I said, I like cable. I'm predominantly a cable trader. But again, just easily digesting this. Do I want to be a weekly trader, 4-hour rotations? Do I want to be a daily trader, intraday, 1-hour rotations? Do I want to be a deep 5-minute time frame intraday trader? Then yeah, you can see the level. And this sets you up for a degree of success. We'll talk about some more nuances in the next lecture, but I'll leave it here for now. It's awesome again, guys, having you. I really appreciate you guys coming here and sitting through these sessions, and I hope it's really impacting your life. Any questions, like I said, ask me in the comments below. Till the next lecture, guys, adios.